The headlines across Texas are painting a dramatic picture of a collapsing housing market, shouting warnings about falling prices, rising days on market, and sellers chopping their list prices just to get an offer. At first glance, it looks like the state is spiraling into a full-blown crisis, especially in cities like Little Elm, where price declines between 5% and 11% are turning into viral talking points. But these flashy headlines miss the real mechanism behind the shift. They point to price drops and scream meltdown, but they don't dig into what's actually causing the slowdown beneath the surface. If they did, they'd see one number that changes the entire narrative: the dramatic pullback of investors. Investor involvement, once the backbone of Texas real estate, dropped from 9.6% of statewide purchases in 2023 to just 8.2% in 2024, the lowest share in years. Dallas-Fort Worth saw an even sharper retreat, falling from 11.2% to 9.8%. Austin's numbers collapsed from 8.3% to 6.6% in a single year, a staggering 20% drop that shows just how aggressively the smart money has pulled back. This isn't a slow trickle or seasonal dip. This is a full retreat, a stampede out of a market investors once treated as a goldmine. For a decade, they were the driving force behind rising prices, booming construction, and soaring demand. Now they're running for the exits, and without them, the entire ecosystem, construction, valuations, liquidity, starts to wobble. Headlines scream crash. But the deeper truth is that Texas is experiencing an investor exodus that reshapes everything. Texas real estate has always leaned heavily on investors, but their sudden withdrawal has left a void that everyday homebuyers can't fill. For years, investors dominated markets like DFW, Austin, and Houston, where they made up a double-digit share of home purchases and acted as a stabilizing force by snapping up homes that regular buyers passed over. Institutional buyers, hedge funds, rental platforms, private equity groups poured billions into single-family housing, turning ordinary neighborhoods into long-term investment portfolios. Individual investors followed suit, especially during the low-rate era when financing was historically cheap and rental yields were sky-high. But 2024 and 2025 marked a dramatic shift. As returns dwindled, investors who once viewed Texas as a safe bet began to see a market where cash flow was shrinking, appreciation had reversed, and operating costs were ballooning. Unlike families buying their one primary residence, investors are ruthless with numbers. When the math turns red, they leave. Austin's investor share, falling from 8.3% to 6.6%, wasn't a coincidence. It was a reaction to fundamentals deteriorating across the board: declining prices, falling rents, swelling inventory, and overextended homeowners who had bought at peak pricing. In Dallas, the drop from 11.2% to 9.8% signaled that even the state's strongest investment market had lost its shine. These declines aren't small fluctuations, they're warnings. Investor pullback means reduced liquidity, fewer cash buyers, and a shrinking safety net beneath home prices. With the people who once propped up the market stepping aside, Texas's boom era momentum is collapsing under its own weight. To understand how Texas reached this point, you have to look back at the golden era from 2010 through 2022, when the state became the most profitable playground for institutional and individual investors alike. Population growth was explosive. Jobs arrived faster than housing could be built. Companies relocated their headquarters in waves, bringing high-income workers who needed rentals immediately. Investors watched this trend and saw predictable demand, rising rents, and home values climbing steadily year after year. It was the perfect environment for leveraged buying. Mortgage rates under 3% created a once-in-a-generation opportunity to buy multiple homes with extremely low carrying costs. A $300,000 home financed at 2.8% could produce positive monthly cash flow while appreciating 10–15% annually. Investors could buy 3 or 4 properties at a time, rent them out, and watch equity balloon. Institutional giants like Invitation Homes and Progress Residential accumulated thousands of homes, converting neighborhoods into rental-heavy zones where regular buyers never had a chance. Individual landlords followed, buying homes for $250,000 and selling them a few years later for $400,000. Everyone wanted in. Build to rent exploded, especially in Austin, where developers constructed entire neighborhoods specifically designed for long-term rentals. Investors didn't just participate, they dominated, but this frenzy hid a fatal flaw. Texas was becoming less affordable for the very people who lived and worked there. The growth wasn't organic, it was investor-fueled. When affordability finally broke, so did the state's ability to sustain its housing momentum, setting the stage for the retreat we're witnessing today. The investor takeover accelerated dramatically in 2021 and 2022, the years many analysts now describe as the peak of the frenzy. These were the months when bidding wars became the norm, listings disappeared in days, and families found themselves competing against cash-heavy investors who treated houses like stock trades. In certain Dallas zip codes, investors made up over 20% of all purchases. Entire blocks were bought up by institutional buyers before ordinary shoppers even scheduled a showing. In Austin, new construction communities were sold wholesale to corporate landlords. Before a single homeowner could place a bid, it became routine. A home listed on Monday, 10 offers by Tuesday, 3 from families, 7 from investors offering over asking. All cash, no inspection, fast close. Regular people were completely priced out. Investors didn't care if a home was overpriced. They were chasing cap rates, not livability. With rents climbing 15–20% annually, even inflated purchase prices made sense on paper. Combined with near zero interest rates, the returns were irresistible. Build to rent surged. Developers pumped out thousands of single-family rentals, designed exclusively for corporate ownership. By 2023, Texas had become the second most investor-heavy state in the country, trailing only Florida. But while everyone celebrated the boom, they ignored what was brewing beneath it. Unsustainable affordability, rent inflation reaching its limits, and a population struggling to keep up. Once rates spiked and rent growth stalled, the entire investment model collapsed. What once looked like a bulletproof expansion revealed itself as a bubble resting on fragile foundations. The turning point arrived in March 2022, when the Federal Reserve began aggressively hiking interest rates. What seemed like a gradual policy adjustment quickly became the first domino in a chain reaction that would dismantle Texas's investor-driven housing machine. Financing costs doubled in less than a year. Mortgages that used to be 2.8% jumped beyond 7%, instantly destroying the positive cash flow investors relied on. The same $300,000 home that once put money in an investor's pocket now drained hundreds each month. Appreciation, once guaranteed, flipped into depreciation. Austin marked more than 30 consecutive months of year-over-year price declines, dropping nearly 19% from its peak. Dallas also shifted into negative territory after years of uninterrupted growth. For investors who bought in 2021 or 2022, home values fell below what they paid. They were underwater. Rents, which once rose uncontrollably, began falling too. Tenants had leverage for the first time in years. Landlords offered concessions, free months, waived fees, promotional discounts just to keep units filled. Meanwhile, property taxes surged. A home assessed at $350,000 one year might be reassessed at $420,000 the next. Even if its market value had dropped, insurance costs exploded after storms, freezes, and hail battered the state. Investors couldn't raise rents enough to cover these ballooning expenses. The simple truth emerged: Texas real estate no longer penciled out. The math didn't work, and when the math breaks, investors move on. Their retreat wasn't emotional, it was purely financial, and once it began, it became unstoppable. By 2024, the investor pullback had hardened into a full retreat. Dallas-Fort Worth, once ground zero for institutional buying, saw investor participation fall to 9.8%. Austin's decline was even worse, dropping from 8.3% to 6.6%, a staggering 20% contraction. These weren't just numbers, they were symptoms of a market losing the very participants who kept it liquid. Institutional giants, such as Invitation Homes and Progress Residential, slowed or completely halted acquisitions. Some began quietly, offloading properties, often accepting losses simply to exit a weakening market. One firm reportedly sold more than 120 homes in Dallas in 6 months, many at below purchase prices. Individual investors followed. Doctors, engineers, and small landlords who had purchased multiple rentals during the boom found themselves stuck with homes worth less than their mortgages and rents that no longer covered expenses. Faced with rising taxes, surging insurance premiums, and falling rents, they listed properties en masse. But without investors to buy them, listings sat. Days on market stretched to 60, then 90. Price cuts piled up. Some sellers dropped their asking price 5 or 6 times before finding a buyer. Even with new construction accounting for over 27% of Texas home sales, investors weren't touching those homes anymore. Regular buyers were picking them up instead, but not at the volume needed to support the pipeline developers had grown accustomed to. The flight of investors created a vacuum, and with no new money flowing in, the market began sinking under its own weight. In response to growing affordability pressure and a cascading real estate slowdown, Governor Greg Abbott attempted to intervene with aggressive property tax legislation. On the 2nd of February 2025, he stood before the legislature and declared affordability an emergency issue. He called for billions in property tax relief and promised reforms that would keep residents in their homes. Bills moved quickly through the chambers. By June, Abbott signed House Bill 9, Senate Bill 4, and Senate Bill 23, dramatically boosting homestead exemptions and expanding property tax breaks for seniors, disabled homeowners, and small businesses. At the signing ceremony in Denton, Abbott emphasized how much exemptions had grown since he first became governor, portraying the bills as a major victory for Texans squeezed by rising costs. But the subtext was impossible to ignore. These measures helped homeowners, not the investors who were leaving the state in droves. Abbott avoided discussing falling home prices, negative investor returns, or the deeper issues dragging Texas housing into decline. When pressed by reporters about investors fleeing and price drops accelerating, he admitted the state couldn't control the Federal Reserve or overall market conditions. His message, though polished, revealed the underlying reality. Tax cuts alone couldn't reverse the investor exodus. Investors don't return because exemptions rose, they return when profits return. Without appreciation, without rental growth, and without affordable operating costs, no amount of legislative relief could make Texas housing financially attractive again. Abbott could slow the bleeding for homeowners, but he couldn't stop the investment sector from collapsing. As the investor retreat intensified, the ripple effects began spreading through every corner of Texas's housing ecosystem. Builders, who had relied heavily on institutional buyers for years, suddenly found themselves with unprecedented inventory on their hand. Many had constructed thousands of homes specifically for build-to-rent investment groups, homes that now sat vacant. Construction timelines were pushed back, new phases were delayed, and land acquisitions slowed to a crawl. Workers in construction, plumbing, roofing, and electrical trades saw contracts evaporate as projects stalled statewide. Meanwhile, neighborhoods once partially stabilized by investor ownership began showing signs of deterioration. When struggling, investors stopped maintaining properties, lawns overgrew, minor repairs turned into major damage, and curb appeals sank. These neglected rentals dragged down surrounding home values. Foreclosures increased as investors unable to cover negative cash flow defaulted on mortgages. Banks repossessed homes and dumped them onto the market, pushing prices down further. The rental landscape fractured in counterintuitive ways. Some neighborhoods saw rents crash because too many investors were competing for too few tenants, while others experienced rent increases as rental supply shrank. Investor-owned homes were sold to owner-occupants. Texas's once unstoppable construction pipeline slowed to a near standstill. Build-to-rent developments dried up almost overnight. What had been a booming, investor-fueled engine for more than a decade suddenly lost the capital that kept it alive. Without investors absorbing excess supply, the market began correcting rapidly and painfully. This wasn't a temporary slowdown, it was a structural shift, and the full impact was only beginning to unfold. The deeper truth behind Texas's housing downturn is that its investor-driven success story was built on a fragile assumption. Affordability would remain intact forever. For years, the state's competitive advantage was simple: cheap homes, low taxes, and steady population growth. But when home prices doubled in just a few years and rents surged beyond local incomes, affordability died. And once affordability disappeared, population growth slowed dramatically. Net domestic migration fell from more than 220,000 new residents in 2022 to just 85,000 in 2024, a stunning 62% collapse. Fewer new residents meant softer rental demand, weaker absorption rates, and slower household formation. Investors depend on endless demand. When demand flattens, their model breaks. Rising interest rates poured fuel onto the problem, doubling financing costs and killing cash flow. Property taxes rose aggressively as local governments struggled to keep up with higher budgets and insurance. Companies jacked premiums after back-to-back years of destructive storms. Even investors with low mortgage rates couldn't escape the rising cost structure. Meanwhile, home price declines erased years of equity gains almost overnight. Investors who bought at peak pricing in 2021 and 2022 found themselves deeply underwater by 2025. The entire investment thesis, steady cash flow, strong appreciation, endless population growth collapsed. Abbott's tax cuts offered minor relief to homeowners, but none of the structural issues plaguing investors were addressed. Until affordability improves, rates stabilize, rents grow, and inventory resets, investors have no incentive to return. This is no longer just a Texas story, it's becoming a regional trend driven by the same core issues: affordability breakdown, slowing migration, rising costs, and collapsing returns. Anyone tracking the housing market needs to understand this shift because it signals where other high-growth states are heading next, so stay tuned for the unfolding reality and subscribe for the next deep dive.